Happy holidays. It's Chris Pertet from Signet Financial Management. Well, it's a holiday time of year, and it's also the end of the year, so I've been getting a lot of questions from clients about gifting. Now, I don't mean buying a toy and putting it under the tree, but rather larger gifts of monetary value and how it affects your finances. So I thought I'd record this quick video to discuss what the IRS considers to be a taxable gift and how it does affect your taxes and finances, because many people don't understand that gifts can actually be taxable and that there are certain limits constructed around that, and there actually is a thing called gift tax. Now, you may want to gift money, stock, property, or items for other various reasons, and that's perfectly fine. So, for example, giving cash to a qualified charity not only helps you avoid that thing called gift tax, but it can also result in an income tax deduction. And there are some complex rules around who you can gift to and what the implications are. So in this video, I'm going to focus in particular around gifting to individuals rather than charities. Now, the rules can get a little confusing if you're not familiar with them, so I'm going to try to keep this pretty high level, but the whole idea behind a gift tax is that the IRS attempts to constrain the amount of money you can pass to your heirs without any kind of implication. So, for example, let's say you're in a very high tax bracket, and you choose to gift a stock that's gone up in value to an heir who's in a lower tax bracket. Well, what the heir can do is sell the stock and incur lower taxable implications than you would if you sold it, and the IRS doesn't like that. So as a result, going beyond ordinary federal tax, the IRS taxes your gifts. Now, they do this both in life and in death. So yes, even in death, you can't avoid paying taxes. What they do is they combine transfers during your life and your death into a single unified transfer tax system, which provides the same tax liability in any assets transferred. Now, annually, the IRS puts a limit on how much you can pass to another without incurring this tax. And for 2018, that amount's $15,000, and that amount is per donor. So a married couple can elect to gift $30,000 as a couple. Now, this doesn't mean that if you go over that limit, you're going to have to pay taxes, because there's actually a thing called a lifetime exclusion. So what that means is any amount over your annual exclusion can be deducted from your lifetime without incurring any kind of gift tax. And the lifetime exclusion amount can and usually does change each year, but for 2018, it's $11.18 million. Now, because of the 2018 tax reform, that number is nearly double what it was in 2017. So I've thrown a lot of numbers out there, so I want to give you an actual example. Let's say you have a grandson that you want to help out by contributing to their college savings account. Very noble. You contribute $35,000 to that account this year. Now, that's $20,000 over the 2018 annual gift exclusion amount of $15,000. So you have two choices. You can either pay the gift tax on the $20,000 excess, or you can file Form 709 with your taxes and claim the $20,000 against your lifetime exclusion, avoiding the gift tax. Now, what you've done there is you've lowered your lifetime exclusion from $11.18 million to $11.16 million. Now, you may be thinking, what's the big deal? I'll never go over that amount. But I'll give you two things to consider. First, the exclusion rate can change each year, and just because it doubled last year doesn't mean it can't go back down in future years. Now, second, since gift tax and estate tax is a unified system, any amount that you use in your lifetime exclusion is also going to reduce the amount that your heirs are allowed to exclude from your taxable estate when you pass. Now, two of the most common questions I get are, what's considered a gift and how much is the gift tax? Well, anytime you transfer assets or anything that is monetary value really to another individual, it can be considered a gift in the eyes of the IRS. Now, there are a lot of common pitfalls I see people make around gifting, and that includes giving money directly to children for the cost of a wedding, buying cars, tilting accounts in joint names, forgiving family loans, selling property to a family member at a discount to market rate, giving money directly to your children to pay for school instead directly to the institution. The list goes on and on and on. So all of these can be considered gifts in the eyes of the IRS, and all of these are mistakes that have alternatives that can either be minimized or eliminated altogether when it comes to gift tax. Now, as far as the gift tax rate goes, it ranges anywhere from 18% all the way up to 40%, and this table outlines the various levels. Now, if done properly, you can gift to your heirs, gift to your favorite charity, receive tax deductions, and avoid gift tax. And just like any other element of your finances, proper planning while gifting can help you achieve all of these things. I hope this information helps. I love helping people with their finances, and I love making a difference through helping others gift to charities or individuals. It's kind of a win-win for me. So if you have any questions, feel free to reach out. I'm happy to help. Happy holidays, and I hope to see you in the next video. Take care.